Welcome to Financial Detox.
We're your hosts, Jason and Alex from IDA Wealth.
Your financial journey of pursuing better and true financial peace of mind starts here. Welcome to Financial Detox. I'm Jason Labrum, your host in studio with my man,
Alex Klingensmith.
It's the start of 2026. My gosh, we're already a month into 2026. Wow, time goes by fast when you're having fun. Here we are a month in, but is this the setup, the 2000 setup, the 2008 setup, maybe the 2022 setup? It's been an unbelievable bull market run. The markets have been so good that even investors who have no idea what they're doing now think they're really smart investors and they're just brilliant because they've picked all these stocks that have gone up. Unfortunate news for you. Everybody's made money in the market lately because it's gone straight up. The good news is 70% of years, markets go up. So if you just stay invested, you'll probably do well. But what we're starting to see is underpinnings of real volatility, right? We're seeing some market movements. But I think understanding volatility can be something that can help you literally change who you are as an investor and help you have much better outcomes. So let's unpack volatility. We're going to throw up a couple slides here. I think that's always useful, and hopefully we can make them big enough that you can see them. But the key here is if you see something you want to talk about a little bit more, or see how this relates to you, or you want a copy of the slide, then just email us. You can shoot an email directly to me at jason@financialdetox.com, and we will get you a copy of whatever we're talking about today and help you relate this to your personal financial situation. So when we look at our first slide today, here we are looking at crises and events over the last 50 years. This is not a small time frame. And I started in this business about 28 years ago, helping people manage portfolios. And my gosh, we've learned so much over that time. But one of the things that's interesting is when you look back at all these reasons why you shouldn't be invested and reasons why you should be scared and you should maybe get out and sit on the sidelines for a little bit and wait for things to get better, which is a question we have had an awful lot this year, haven't we, Alex? Like I've had a lot of people say, hey, should we just be getting out and waiting? Maybe you should definitely be looking at your portfolio and making sure that your expected volatility is in line with what you originally set out and your current financial plan. Because when your portfolio grows a lot over time, and equities become a bigger and bigger portion of the portfolio, you do need to make changes. Now, it's probably not get out and sit on the sidelines and hope you can time the bottom, because that doesn't work like that very well. But it is make some changes to the portfolio. And what we see in this chart, 11% return for the S&P 500, just a broad benchmark of stocks.
Well, not only a broad benchmark of stocks, but I mean, like I would love to see all the charts of our diversified portfolios that look like this, whether it's the NASDAQ, whether it's the Dow, whether it's private alternatives and their different asset classes. I think the point is that you used to make when we used to speak in front of large groups, which we still do, is used to joke and say the S&P 500 is not.
It's not the market.
There you go.
And it's a piece of the market.
We're showing that data for a reason, though, because it is the most highly, I think, popularly tracked index in the world. Right. For good reason.
It has the longest standing history. So something to look at there. So look, the markets do well over time. But that doesn't mean you should just put your investments to work and never touch them again. It's really important that not only are you tax loss harvesting and you're rebalancing your portfolio, and that needs to be tied to something. And that should be tied to a full cash-based financial plan. We've done some shows on those. Check them out in the past here in the last couple of weeks and months about financial planning and how that works for you. So
Jason, I'm going to set you up real quick here because I think the listeners would want to hear this. And I know that past performance is not a guarantee for future results. We don't try to forecast and predict the future. But if you were try to predict the next big blip on this year, perhaps, and I'll draw your attention to 2000, 2001, because a lot of people are asking, is this another one of those? Yeah. Right? Well, what do you think is going to be the next thing that's going to cause the next drop, crash, recession, depression?
It's one of 2,000. So let's start the clock and I'm going to list them all. And if you really think about it, there's literally thousands of variables that could trigger volatility in the markets. The markets don't like uncertainty. The great thing about investing is you get to decide how much volatility you're exposed to. It's like driving a boat. And if you've ever driven a boat, there's a throttle typically on the right-hand side of that boat. And as you push the throttle forward, you go faster. As you pull it back, you go neutral. When you go fast over bumpy water, it's really uncomfortable. I mean, it is a wicked ups and downs. I mean, it's not smooth. When you go slow, it's smoother. That throttle is an analogy to how you construct your portfolio. You can construct it with the throttle down. You'll get where you're trying to go faster, probably, but it's going to be a really uncomfortable ride. However, if you pull that throttle back, it may take you longer to get where you're going, but it will probably be a much smoother ride. You can enjoy your cocktail on the way, which is fun. And so I would recommend slowing it down and finding the right cadence of, hey, I need to get there at this time, but I also want to make the ride smooth. Let's look at another chart, because I want to pivot the conversation, Alex, to like, what is volatility? A lot of questions we've been receiving lately at IDA Wealth, our wealth management firm, is the markets really are seeming volatile. Things are crazy right now. And our answer to that is, yeah, kind of. I mean, the markets have pretty much gone straight up for 10 years. There's been a few blips. They've been very short. That's the difference between a 2008 and then back to a 2000 and back to early 70s. The markets have had very short, sometimes punchy corrections. 2022 was punchy. COVID was punchy. But market volatility is normal. In this slide, we talk about, again, we're using the S&P 500 as a broad just benchmark to say, generally speaking, how have stocks done? This slide shows how many days in each of the subsequent years listed down below 2009 through 2025. How many days did the market move more than 1% in a year? So 117, 76, 96, you can see the different years. On average, 65 days in a year, the market moves more than 1%. The point being, markets are volatile. They're supposed to be volatile.
That's like 1 out of every 5 days. If my math is right.
A 1% move. Yeah.
Yeah. So 20% chance it's going to be moving enough to get your attention if you're looking at it.
So let's just take a look at this other. There's a lot of information on our third slide here, but I want you to unpack this. And again, send us an email, jason@financialdetox.com, if you want to get this. And what we want you to take away from this is you do have to assess your portfolio and how much volatility you're exposed to, or risk. You could use those words interchangeably. And we can help you do that, and we want to help you do that. But taking a look at this last slide, this thing just, I love this. This is one of my favorite slides. Lots of information on it. What I want you to do is focus on the blue and the orange. The blue indicates where the year ended up in a total return. And the orange indicates at what peak to trough volatility was experienced during that year. What is crazy to look at is going clear back to 1980 through 2025. The average year, there was 14% downside volatility. In other words, at some point, the market was down 14% from whatever point it was at.
The S&P 500 part of the market.
Yeah, we're talking about a small part of the market. The S&P 500 but still a pretty good proxy for, generally speaking, how did U.S. stocks do? Unbelievable. Let's just look at 1 year so you kind of understand the chart. Start at the very first year, 1980. The market ended up a positive 26%. But there was one point during the year, the market was down 17%. Let's fast forward to 2000. And if you look at 2000, the market was down 10% for that year. But at one point, it was down 17. So pretty insane things. I love 2020. If you look at 20, the market was down 34% at one point during the year.
Yeah.
But yet you ended up a positive 16. So, I mean, nothing encapsulates what market volatility is and how to be a better investor than this slide.
Can I tell a quick little story? I know we're going to go over on time like a lot.
Unbelievable.
You're going to have to chop me
it's
out of
be a
this thing
30
later,
show.
but that's okay. This is a good story because I think
Alex.
if you're listening to this and you're listening to the data, you're like, yeah, but it's different this time, or yeah, but like okay, your emotions have a huge part in how you invest in your behavior, right?
True.
We told a story of a client last week that one of our advisors met and became a client in March, like early March 2nd of 2020,
right?
Which was, or no, it was February 3rd of 2020, excuse me, about 6 weeks before the COVID, like Armageddon started.
Pandemic, right. Oh, I remember this.
And the reason why the story, and I'm not going to tell the long version. So, if you want to hear the long version and hang out with me, just email Jason and he'll set you up with me. But Jason at financialdetox.com. But the reason why the story is important is because these years do happen and they will happen again. And this client started off on their journey as a client right before one of the biggest, most volatile S&P 500 years ever, right? But because they work with one of our advisors and built a financial plan and talked through the behavioral aspects of investing, learned how we do things objectively with discipline, they didn't make mistakes. And they ended up in such a better place through all the things of their life, through the COVID crash, through 2022 and to the present day. And they're in such a good position. They had the peace of mind to go through that journey because they were able to exercise that discipline.
I think that's a way to end this and say that we can bring you on that journey, or you can get on that journey yourself. But we would love to help point you in the right direction and get you moving in that way. This is not a sales pitch. This show is about educating you and empowering you to make better decisions, whether you do it on your own or whether you want help. Seek a fiduciary financial advisor. Have a true interactive, never dying, long living, lifetime financial plan. Make good decisions. Know that markets are volatile. They're supposed to be. And you will be able to live the true financial peace of mind journey that we adhere to here at Financial Detox. I think that's it for now. What do you say, Alex? Can we wrap it?
Sign me up. Let's go.
It's Financial Detox. I'm Jason Laban with Alex Klingensmith. Thank you for tuning in. Give us a subscribe, like, all that stuff, whatever seems right to you. And have a good one. Happy investing.